Hi, imagine if you could actually own a small piece of your favorite company, like a slice of Apple, Netflix, or even Starbucks. Sounds unreal, right? But that's exactly what happens when you buy a stock. You become a part owner of a business. Yep, an owner, even if it's just a tiny share. In this video, we're going to break down what stocks are in the simplest way possible. By the end, you'll understand this important money concept without any confusing Wall Street jargon. Chapter 1. What are stocks? Let's make it simple. A stock is just a piece of ownership in a company. Think of a company as a giant pizza. If the pizza is cut into 100 slices, and you buy one slice, that slice is your stock. You don't own the whole thing, but you do own a piece of it. So when you hear someone say, "I own Apple stock," what they're really saying is, "I own a small slice of Apple Incorporated." That slice comes with rights, value, and sometimes even profits. To make this real, let's meet Jake. Jake's a college student in California who pretty much lives in Nike sneakers. One day, Jake thinks, "Nike is huge. Everyone I know wears these shoes. I wish I could be part of this company." So, Jake decides to buy one share of Nike stock. Now Jake is officially a part owner. Does that mean he gets to sit in meetings with the CEO or design the next sneaker? Nope, but if Nike makes more profit, invents cool products, and becomes more successful, the value of Jake's stock goes up. And if sales slow down or the company faces problems, the value of Jake's stock can drop. But either way, Jake can now proudly say, "I own part of Nike." Chapter 2. Why stocks are bought and sold. Why companies sell stocks. Now let's flip the question. Why does Nike sell stocks in the first place? Why give away parts of the company? Simple, money. Big companies need cash to grow. Maybe they want to open more stores, create new designs, or expand worldwide. Instead of borrowing from the bank, they sell slices of their company, stocks, to the public. When a company does this for the first time, it's called an IPO, initial public offering. Think of it like your friends starting a coffee shop. They don't have enough money, so they let 4 friends chip in, giving each one a share of the cafe. That's exactly what companies are doing when they go public. Why people buy stocks? So why do people, like Jake, buy stocks? A few big reasons. Profit from growth. If Nike keeps growing, Jake's stock might be worth more in the future. Dividends. Some companies share profits with their shareholders in the form of cash payments. Wealth building. Over many years, stocks are one of the most powerful tools to build wealth. In fact, if you had invested just $1,000 in Amazon back in the late 1990s, it would be worth tens of thousands today. That's why people invest, the chance to grow money over time. Chapter 3. How stock prices change. But stocks don't sit still. The price of a stock changes every day, sometimes every minute. It all comes down to supply and demand. If lots of people think Nike is about to release the next big thing, demand goes up and the price rises. If people are nervous and start selling, the price falls. News, global events, company profits, even tweets, even social media, can send stocks up or down. Remember when certain stocks like GameStop went viral and prices skyrocketed? That's the power of demand in action. Chapter 4. Risks and rewards. Now, here's the truth. Stocks are exciting, but they're not always safe. There are risks and rewards. Rewards. If the company does amazing, you might make a lot of money. Risks. If the company struggles, you could lose some of your money. Imagine Jake again. If Nike sells a shoe that becomes the hottest trend, Jake's stock could soar. But if Nike has a scandal or sales crash, Jake's stock could drop. Stocks are like a roller coaster, thrilling but full of ups and downs. This brings us to long-term versus short-term investing. Short-term investing is like trying to predict next week's weather, unpredictable, stressful, and often wrong. Day traders try to buy and sell quickly for tiny profits, but it's risky. Long-term investing, on the other hand, is like planting a tree. You plant the seed today, water it, and over many years, it grows into something big and valuable. That's why investors like Warren Buffett are so famous. They buy great companies and hold on to them for years, even decades. Conclusion. So let's wrap this up. Stocks are simply pieces of ownership in a company. Companies sell them to raise money. People buy them to grow wealth. Stock prices rise and fall because of demand, performance, and news. Stocks can make you rich or lose you money, but over the long term, they've been one of the best ways to build wealth. If this video helped you finally understand stocks, do me a favor, hit that like button so more beginners can see this too. Make sure to subscribe for more simple finance lessons and leave a comment. If you could own a piece of any company, which one would it be? Apple? Disney? Tesla? I'd love to hear your pick.